Az OM Podcast mai epizódja egy igen különleges adás lesz. Ma ugyanis Fabio Giacomettivel fogok angolul beszélgetni a pénzügyekről. Fabio egy nagy olasz cég CFO-jaként dolgozik, emellett egy külön képzéssel pénzügyi tanácsadással is foglalkozik. Ügyfelei olyan gazdag és befolyásos emberek, akik szeretnék a lehető legbiztonságosabb módon megőrizni és gyarapítani a vagyonukat. Most az évtizedek alatt összegyűjtött tudását és tapasztalatát nekünk is átadja, és egy tábla segítségével magyarázza el, hogyan hozhatod ki legtöbbet a pénzedből. Ha szeretnél olyan embertől tanulni, aki valóban dollármilliókat menedzselt már, akkor mindenképpen megéri ezt a videót megnézni. A podcasthez AI segítségével készítettünk magyar feliratot is, hogy mindenki számára elérhető legyen a tudás. Igyekeztünk minél jobbra csinálni, de a feliratban még így is lehetnek hibák, ezért előre is bocsi.
Buongiorno Fabio, grazie per essere venuto il mio podcast.
What a wonderful Italian! Köszönöm szépen, Christoph!
Thank you, Fabio. So, first of all, really thank you for taking the time and coming to my podcast and talking about finances. Before we start, I always ask every guest to introduce himself, like in 5 sentences, like why are you here? Why I invited you? Why I think that you're a credible person talking about finances?
Well, why you invite me here, it's your problem. I'm here because I like finance, and we met at one of my course.
Yes.
It was a course in finance that I'm holding in my, let's say, in my spare time, as I'm a CFO. But first of all, I'm Fabio Giacometti, and I'm living in Hungary since 2006. Unfortunately, my Hungarian is not so good that I can speak today with you in your mother tongue, but yeah, I'm working in finance. I'm working as a regional CFO, so I'm working in Hungary, Romania, and Poland for our group. It's an Italian group in the plastic sector. I'm here because I have the task to develop these factories. They are, let's say, new in the group. So the group is more than 50 years, and these new companies, they are less than 10 years old. So here we have to develop, my task was to develop a new financial department. So I started 13 years ago, and step by step, it's a family company, so we start to build the financial team, Hungary, Romania, and Poland. We introduce ERP, SAP, and now, after 13 years of activity, thanks to my colleagues, we are able to have, I would say, a really modern financial office in the group, in these countries.
That's interesting. And how that sparked your interest, like finances? When did you start to?
Finance, it was always important to me. And I had always this spirit, this animal spirit about money since I was a kid. I started to, whatever I could, I was trying to sell and to build something. And then when I went to the university, I decided to have this business administration because I like finance, I like controlling, and I like to build teams.
Yeah.
And I think that in finance, I could get all of this together.
Exactly.
It was a nice experience.
Yeah, just like a quick introduction, I met Fabio at his course because one of our close friends invited me, because told me that Fabio's course is the best investing course he has ever been. So I was like, well, okay, why not? And then he told me that Fabio doesn't like crypto. So I was like, okay, I'm a bit concerned about that. But yeah, why not? Let's see. And after the course, I was like rebalancing my investment portfolio and also diversified to stocks and ETFs, but we will get into that later. But really, I can tell that it was the most practical course that I have ever taken. So thank you, Fabio, for that. Okay, let's get into it. The first thing that it's really interesting for me, and what's on your take, is like, what are the biggest financial misconceptions that you see people have here in Hungary? You are living here 20 years?
Yeah, I'm living here since 2006. Being a CFO is different than to be a financial advisor.
Exactly.
So I became a financial advisor only in 2022 during the COVID, because I had the opportunity to attend a specific training in Italy. be a financial advisor is a little bit different because even for me, I needed to start and to learn from scratch these things because a point is to manage a company or a group or a big group, but it's different to manage your personal finances because it's a lot of psychology, emotional, and things like that. What I see here in Hungary, it's not that different than what is happening in Italy. So all the people, the Hungarians or who doesn't have experience in finance, they do all of the same mistakes. So for example, everybody believes that the cash is super safe, and during the course we understood that if you let it on the bank account, yes, it's safe till the inflation is not hitting it.
Exactly.
Don't forget what happened here in Hungary in 2023 with inflation 25%.
It's crazy.
It's difficult to lose 25% in a stock. Okay, if you don't play with cryptos. But if you play safe, even in the stock market, 25% is a lot. Can you imagine all those people that they had their money in the bank? They lost it, and they didn't realize it. Other misconception that you can see between the unprofessional or, let's say, investors, it's the attitude toward the banks. So or you love it or you hate it.
Yeah.
We had this little bit test at the beginning, and you love it if you don't know them. You hate them if you know them, because the problem here in Hungary, and that is a little bit different than the other countries, the Western. I don't know if I can use Western.
You can.
But let's say Italy, France, Spain, Germany, the market is a little bit different. Here, I would say we are still at the 70s as offer from the market, from the banks. And that is the problem for us that we are living here in Hungary. We don't have, on the other side, a professional team of people that are teaching us how to use the bank. And when you face and you go to the bank, what's happened? That they sell what they have on the shelves. They don't care about your needs, your experience, your emotional state. The important is try to sell what they can. And this is why a lot of people started to hate the banks and to avoid banks. And the other misconception is the real estate. Everybody is investing in real estate. There are cryptos and real estate. And it seems that there's nothing in the middle. Yeah. And this is my training, my course. What is it about? To give an option to those that think that maybe, by the way, I don't hate cryptos. I like a conscious use of the cryptos that is different.
Exactly.
And this is what we saw together. From the other side is the real estate. Even the thinking that real estate is safe is like that the cash is safe. If you have tried to invest in real estate in Budapest now, you will see what does it mean. So if you buy a new house, the technical risk is really big because there are a lot of issues with the new condominium, but even with the old one, because the pipes, they are really old. And then you find out that you wanted to live with a nice income from your tenants, and then you are messed with a lot of technical problem with the plumbers and electricians, and you get crazy. So even that risk, it's something that you should be analyzed before to step into the real estate, to be sure that you know what you are doing, even from that side.
And also what we talked about, like, I don't invest in real estate because it's not liquid for me and for my needs. But I have a lot of friends who only invest in real estate because they get leverage. And it's different for every person. So
exactly. We have to use the right instruments in the right time, in the right moment, I mean, with the correct purpose.
Yeah, and that's why I went to your training, because then our friend said that that your training is teaching how to maximize profit while minimizing the risk. And what I did with crypto is maximizing profits, but I didn't minimize the risk.
That's a point, yeah.
And that's what I learned in that course. And that's why I wanted to invite you for this, because for me, it was like a missing piece in the puzzle, you know, that was really missing from my financial literacy and my financial knowledge. And that's why I wanted to diversify my knowledge in that field. Okay, let's go to the next one, like the basics, really. What does financial literacy mean to you?
When I start to study for myself, for my needs, I understood that what I was doing is try to drive a car without driving license. And it can be dangerous. And at the beginning, I crashed.
Yeah, like everyone else.
Like everybody. So, and when you crash at my age, you can do really bad damages to yourself. Yeah. So I stop it. I start to study. I had this 1 year training in Italy related to, so it's a training that is for bankers. Okay. It's a professional training, so I have a certificate that allow me to teach, but even to suggest how to invest to the others.
Okay, so like a financial advisor,
He's
like
a
individual financial advisor.
Yeah, I'm officially a European financial advisor.
Okay.
So it's a certification that is recognized in Europe, even here in Hungary. Okay. So, and I'm listed in the National Bank as financial advisor here.
Okay.
So literacy, it means, okay, you have to drive your car, you don't know how to do it. Okay. First of all, it's better that you realize that you don't know how to do it, because then you can avoid some mistakes. Then you start with the theory, but even with the practice. So the two words together, they have to be considered. So the theory is good, but the practice, it's really technical. And how you start to drive your car, you know exactly what can be the risk, but it's when you drive it that you understand how you react to those risks. And I focus my course on this. Yeah. So to avoid to face a truck in the middle of your lane, and the course is, it's not what to do when you see the truck. It's what to do to avoid to get the truck before. That is important with your knowledge. This is the main thing. And literacy, what does it mean? So not only understand what is a bond, what is a stock, what is the interest rate, how the interest rate compound itself, but to understand what does it mean to pay the commission to the banks, for example. How to find the best broker on the market. How to optimize the taxation.
Yes.
And these are practical things that you have to understand and you learn in the environment where you are, in the moment where you are.
And that's what we talk about now. So first, let's get into theory, but maybe with some practice. You talk about pillars in your training and also reverse budgeting.
Yes.
Let's start with reverse budgeting. What does it mean?
Reverse budgeting. So I'm a financial manager. I used to do budget.
Okay.
Okay. So you meet with your managers. You decide what is the next year target, and that's all. When you speak about your personal finance, it doesn't work.
Okay.
It doesn't work because it's what is happening in your mind is that you save what is left.
Exactly.
99% of us does this. I earn, I spend, and maybe I save. That's the issue. The reverse budgeting is a game changer. So it's telling to you saving first and then spend the money. It's like to have two baskets. So
maybe you can draw.
For example, you have your first basket.
Okay.
Sorry, I'm a financial manager.
Okay.
Okay. And the second one.
Okay.
That and you can call it now and later.
Okay, so now and later.
Now and later. Normally, we think about now what I need now, what I want to buy now. But with the reverse budgeting, we say, okay, what I want now is savings.
Okay.
So you point your target, how much you need. Let's make an example. During the course, we had that nice characters that was called Apple Melinda. Do you remember her?
Exactly, yes.
So Apple Melinda was in the situation that she's young, she's facing the world, she has just finished the university, she wants to live alone. And we saw what does it mean in terms of finance. So she had to review her budget, targeted for, let's say, 100,000 forint of savings, because her target was later to buy a nice house.
Okay.
And well, then we discover what she has to do to save 100,000 forint a month while she was earning 300,000 forint net.
Yes.
Is it possible? Live alone, do this? No, it's not possible. We understood it, and then this is reverse budgeting. Is take yourself out of your comfort zone, because you have targets. First of all, you need your targets, you understand what you want, and then with reverse budgeting, it helps you to understand how to reach what you want.
Okay.
That's the difference between a budget.
So in that scenario, like in that 300,000, we are not able to save 100,000. So
if you want to live alone, we saw it mathematically.
It's not possible. So two things you can do is like spend less, so cut costs, or increase your earnings.
Exactly. And this is what we saw.
Yeah.
And you have both options. It's not just one, because a CFO goes here.
Exactly.
But a financial advisor, and if I have to support somebody, the other part is increase your earnings. Of course, you have to have double work.
Yep.
You have to think maybe to invest some money in some new trainings, to get better in your job, to increase your position. But this is the target that you can, so you set your target achievable targets. Okay. And then one step after the other, you will see that you are growing.
Okay.
And the attitude that I see even in the youngster now is that I don't see this active attitude. It's much more a passive.
Exactly.
It's in Hungary you have this nice word hat.
Yeah, exactly.
We should cancel this. Hat, it should be cancelled.
So also in reverse budgeting, it's like not. Well, I think Warren Buffett said this, like, or Charlie Munger, I don't remember. Like,
one of those.
Don't invest what you have left. Spend what you left after investment.
Exactly. Yeah.
So here also, I think you don't know this application we talked about in the course. It's called You Need a Budget. It's like a mosaic. And I use this application for like 4 years now.
Yeah.
And what it does, I can track my expenses, but do it before. For example, I have eating or eat outs. I have like home, like categories, you know. And in the first of the month, I can tell already that I want to spend 30,000 here, 70,000 here. And when I spend, I just write it that I spend like minus 3,000. So every time when I open the application, I know how much left here till the month.
It helps.
And psychologically, it helps to spend less. But it doesn't help with this one.
No, because this helps to spend less to stay in your budget. But if you want to build something, you need a reverse budget.
Exactly.
Because it's a much higher level, and it gives you. You remember that with the reverse budgeting, we could see what is happening in 20 years to you if you follow this. If you don't do this, and you see what will happen to your finances, and this is a game changer because you feel it immediately that you will not get. Never this house that you want. You cannot live in your own house if you don't act on these parameters.
Okay, so can we get into pillars, cash flow, and stuff like this, or should we move through with the reverse budgeting?
But the pillars, we need time for the pillars.
Okay.
We need time, and you need to see what does it mean in reality, reverse budgeting. Because, as I said, it's not just theory. We need practice.
Okay.
And that's why my courses, they are not online, or we need to do it
in
together.
Person,
in person, because you need to, it's manuality, let's say, that you have to learn. It's not just a theory, because you can read about, even you said, okay, Fabio, now I understood what does it mean, reverse budgeting, because you can read about reverse budgeting, but till you don't use it in your personal life, as we did, you will never get that feeling.
Okay, so let's move on to cash flow, because I think most people in Hungary don't understand cash flow, and this is the basic for reverse budgeting. So can you explain cash flow for like a normal person?
There is a nice sentence in finance that said that profit turnover is vanity, profit is sanity, but cash is reality.
Okay.
So cash is what you can use to spend. Whatever else is profit, it's interesting because it gives you a direction, direction that you are doing. And turnover, so you can have big income, but I have a lot of friends that we have really high earnings, or high salaries, but at the end of the month, they are left with zero.
So if I have a friend who earns like 1 million forints per month, and he spends 900,000 forints per month, and then he's net 100,000, so that's the positive cash flow he has per month, right? So, and if another friend has like 2 million and he spends 2.1, then he is negative cash flow 100,000, right?
Yes, and there are a lot of Hungarians, this is something they see, especially here in Hungary, that are using revolve credit cards here in Hungary.
Exactly.
It's something that even with our employees we try to don't support, because they basically use 3 salary in advance, and they are negative with the bank, and then they have to come to us, ask a loan to us to close the loan with the bank, because the interest on those, it's crazy.
It's crazy.
So you enter in a path that doesn't leave you any oxygen in your life. So even if you are balanced 2 million with this revolving card, then you are dead.
Exactly. So, and here in this scenario, this person is getting richer every time, and this person is getting poorer every time, right?
Absolutely. And it's really difficult to turn this person into this person, because it's much more emotional. It's when I speak about the reverse budgeting with this person, they look at me and say that I'm crazy, because they think that this YOLO philosophy that is now. I had several people in my courses that were thinking this way: Fabio, if I follow you, I will never enjoy my life. I cannot buy nice shoes. I cannot have nice bags. I cannot have a Ferrari. No, it's not that. But you have to balance your life. You cannot live in debts, with debts. So, because at the end, money doesn't make you happy, but they help you to live.
Of course.
And between this and this, for sure, this one has a problem less than the other one. So
I think the first step is just to measure your expenses and your incomes and see where you are in the cash flow.
In the reverse budgeting, what we do is exactly this. So you first of all fix on your income and then build your outgoing based on your capabilities. Check what is left, and assess if this is enough for you or not.
Okay, so this is the first step.
Yeah.
What's the second?
The second is the second step is the most difficult, is to understand what you want from your life.
Okay, so what house I want?
What kind of house you want, what type of family you want, what type of lifestyle you want.
Okay.
Because there is this economic theory from Modigliani that said that everybody lives on the average income salary of your life. So basically, if you are a savvy person, you should build your lifestyle based on your income. And this is not always true. So this is a nice economical theory.
Yeah.
And but it's important that you revise your needs and you build your cash flow. If you don't build your cash flow, you will always be there. You will never grow up. It's fine as far as you have an employee that is giving you 2 million. But if they stop, what happened? This is what I feel that is not so clear here. That one day the party will finish, will stop. Yeah. And that day you will be left only with the bank card full of debts.
Exactly.
That's really dangerous.
You know, there is a research here in Hungary. I don't remember from which bank is it, but if you have 6 months emergency savings,
yeah.
so 6 months that you can live in the same economic lifestyle without work, you're in the top 1%.
It's a disaster.
It's crazy.
It's yes.
So after that, so we have our cash flow. We know the numbers. Well, what is that? For example, let's say we have like 200,000 positive cash flow
yep.
per month. So it's like 200. One of the problems that I was stepping in,
yeah.
that I have positive cash flow and cash is stacking up on my bank,
yeah.
but I don't know what to do with it. And inflation eats it. So after that, you told that we need our dream lifestyle, like
yeah.
house, cars.
You need to have your targets, understand if they are achievable.
Okay.
And make it happen.
Okay.
And for this, you need to get out from your comfort zone for sure.
Okay, so in this scenario, for example, I say that I want a house which is like 100 million. I want a car which is like 20 million. Forints, yeah. And then I know that I need 120 million
yeah.
for these two.
Yeah.
And not speaking about children, university, anything else.
Get
just
married.
Just stay with
wedding.
this. Okay, so if I want to buy these only from this,
yeah.
it's like unachievable, right?
It is. It's unachievable, but for example, you can have your house. You need to understand how much is the capital that you need to start your loan.
Okay, for example.
Example, so with 200,000 a month of cash flow, maybe you can build up in 2-3 years your first capital, and then with that one you can go to the bank and start your loan. And this is the simulation that you need to do, mathematical simulation. That's why we are using a little bit of Excel in our course to understand if your dreams are achievable.
So after we have this.
There is, during the course, we build what you call the pillars. So there are stages that you have to, before get to this, you need to have your emergency fund, you need to understand what is your needs in the next, let's say, 5-10 years. Once you start to build your pillars, then you can start to think about investments. And to build the pillars, it's not an overnight thing.
Of course.
And that's why the target should be achievable, because first of all, you need to be safe, to have a decent emergency fund, to understand what are your needs. So, for example, these are targets. And take an example that you want to buy your car in 3 years with 20 million. Maybe your family will support you, whatever. You need to build up your savings. But would you start to use them with stocks, or you want to invest your savings in crypto? So the pillars will tell you what to use, when to use, and you classify your dreams in something that you can build.
Okay, so can we just build out like a dummy pillars, like 2 pillars or 3 pillars, just for the sake of it? Like the first pillar.
Okay, so here we have the first, the second, the third, and let's say the fourth. Okay, the first one is your cash. What you need. in your daily spend. So
Okay.
We will analyze it during the course. Everybody has his own needs.
Okay.
And for example, I can live with 500 euro per month, but then I want to have a nice holidays, go to Maldives, and then I need 10,000 euro, or let's say 4 million forint. I need to have those money on the bank account.
Okay.
So I need to study a little bit what is my 1 year cash flow, my 1 year expenditure, and build my cash. That one. The first pillar usually is what you have in the bank account. Second one is the emergency fund. Okay. Everything can happen to you. You can break your car. You need to repair your house, your dishwasher. So we start to build a safety.
What is a recommendable emergency fund?
In terms of amount?
Amount, yes.
It's really personal.
Okay.
I have met people that have 10,000 euro and people that they have €500,000. Okay. Because they are scared to lose their job. They are scared that something can happen. It's really personal. And the important point is that the pillars gives you the risk that you have to face if you want to invest. So the first pillar is cash. Second pillar is bank deposit. It's something easy, something that you cannot risk.
Yeah, like what we talk about.
And it should be liquid.
Yeah, in Revolut, where they pay like daily.
Yeah.
Or overnight. Yeah, okay.
And then you have the third pillar is that in the second pillar you don't know what can happen. In the third pillar you know what can happen. So I want to send my son at the university in USA, and then I want to stock 120,000 euro. These are real cases that we built together with some of our students. You wanna buy a new house on the seaside.
Okay. The car also.
The new car. You know that in the next 5 years you need a new car, so you built it. Or you wanna start a new business. So, for example,
so business also.
It's a business, and even in this case, what you can do, it's even in this case I wouldn't use the stock exchange.
Okay.
These savings shouldn't be placed in the cryptos in the stock exchange.
Yeah, because then the risk is so big that maybe you lose all of this.
And once you have filled these three categories, let's say that you have done your safety zone. Okay, then you go on the fourth area. The fourth area is the area where you don't need those money for the next 10 years.
Okay.
Okay, 10 years, it's a parameter that is connected with the stock exchange. So the asset allocation, we call it asset allocation, should be managed here at the fourth pillars, where you start to build your own wealth for the future. When you buy your house, you don't buy it to keep it 3 years. You buy it for longer period. So that part is part of your wealth that is in the fourth pillar. And then even the stocks. Some bonds, if you want, cryptocurrencies for sure.
So it all goes here.
Here, whatever you can invest, whatever you don't need.
Okay, so this is the investment one.
This is the investment area.
Okay, yeah. So this one is the bank.
Yep.
What is staying is the bank. This one is like
bond. Bond or deposit, bank deposit mainly.
But it's liquid. Bond is liquid?
Liquid, they need to be liquid because you need it, you can need it in 1 day. And then, so if you have your dishwasher broken, your wife is not going to wash.
Yeah, or maybe flexible cash funds?
Yeah, there are some instruments that you can use. I don't want to go now too deep in the...
Of course.
But let's say this is the idea.
Here, third one?
The third one is absolutely bonds.
Absolutely bonds. Okay.
Absolutely bonds.
Okay, and the fourth
one? When I say bond, I mean T-bonds, treasury bonds, or corporate bonds.
Corporate bonds.
Depends on your target.
What is the average return on a bond?
At the moment, in euro, it depends on the duration. It's around between 1.8 and 3.6%. Well, you can even you can even buy some Romanian bonds at 6%.
Yeah, but then you have the risk.
It's a risk. It's still a decent risk for the market. Of course, if you get 6% against 3, they are more risk. But they are still investment grade. It's some technical classification that we need to know. So investment grade here, and then here you can play whatever. Here you can have commodities, you can have gold, oil, physical gold, cryptocurrencies, and bond. How to build? It's another point.
Yeah, it's another topic. But yeah, this was really helpful for me, because here I realized that most of my investments are here.
Yeah.
And I don't have investments here. Yeah. So that's why I rebalanced it, some of them. And one lesson which was really helpful for me is that I have emergency funds, but it was sitting in cash, like in real cash, not in bank account.
Like the agents.
Yeah, like the agents. And then you told me that it's absolutely stupid. And I was like, in my scenario, it's stupid.
Yeah.
And that's why I did like, mine is in Revolut, flexible cash funds, and did in pounds and US dollar, because it pays like around 4% APY per year, and it pays like daily. What's the problem with this?
The problem is that here we said that is your emergency fund. I need 10,000 tomorrow morning to buy my new car.
Yep.
Look your case. You invest in US dollar. US dollar, they just lost 10% on the market.
Yep.
Your 10,000 euro now, they are 9,000 euros.
Yeah.
What's happened? What can you do now? You cannot buy your dream car. You have to go down on your willing. Okay. Maybe you cannot, because you needed that specific car, or you need to repair your house, the roof of your house. Your wife wanna change the tires at home. You cannot.
So would you take like euros here? What would you recommend?
It's based on the currency that you are going to spend. So it should be zero risk. If I know that I wanna spend forints, this emergency fund will be for the internal market. So it's to spend here, I will keep forints. If I have some, for example, emergency fund for my family, because I know that my father is getting old, probably they will need support from my side. I want to keep some fund for them. They are living in Italy. I will keep 10,000 euro, 20,000 euro in euro.
In euro, okay. Well, what if I take it in forints in Hungary and the inflation is really high? Then I also lose there.
If you have, we said that you should invest in bond. The Hungarian bonds, they are a good option.
Okay.
They are good to protect you from the inflation.
Where can I buy Hungarian bonds?
I cannot pronounce that name.
Államkincstár?
Exactly.
Okay. So the Államkincstár is this one. Yeah.
They are a good option for the internal market.
Yeah. Okay. So let's move on, because this was really technical.
Yeah, it's almost a good part of the first lesson of my training. My course.
Let's talk a bit about inflation and buying power.
Yeah.
So how would you say inflation, or how would you tell inflation for 14 or 15 years old Hungarian boy or girl? What is inflation?
Inflation is that today you can buy your ice cream with your money that you have, with your 1,000 forint, you can buy your ice cream. But tomorrow, because of the inflation, the price of that ice cream is 25% bigger. And with your 1,000 forint, you cannot achieve that ice cream.
So now
if you are a 10 years old kids, you can get nervous.
Yeah, so now you can get only one cup of ice cream.
Yes.
Or maybe like 1.5.
1.5, let's say. And this is what is happening to the markets. So if you see on the in the distribution, they are reducing the quantity that they serve to you at the same price.
Exactly. And it's interesting, because what you tell in the first part of the podcast is that all those people who left their money in the bank account when the inflation was 25%, they lost money. Yeah. Technically, they don't lost money, they lost buying power.
Buying power, exactly.
So the money was exactly the same, like 1 million forints, but you couldn't buy the same thing for 1 million forints after 1 year.
Correct. And this is the part you don't feel it because you don't feel it, and you don't as you don't feel the pain, you don't look for a cure of it. And then when you realize that it's an issue, it's too late. You lost 25%. But in Hungary in 2023, it was really strong, the 25%, so everybody understood that moment. But look in euro we are losing 2-3% per year. And if you left a lot of money in your bank account, in 10 years, you lose more than 20% because it's compounding.
Compounding, yeah.
And you don't realize it.
Yeah. And that's what I wanted to talk about. Like, if someone has money in the bank and don't invest it.
If you're using reverse budgeting, you have to build your money.
Yeah. And also, like, how much is the inflation in Hungary? Like, average?
4% at the moment.
4%. And in euro?
It's 2.1.
2%.
Yeah.
Okay. So it's double.
Yeah.
So if my currency is in Hungarian forints,
yeah.
I lose it twice the time than if it's in euros because of compounding?
Yes, you lose compared to the euro.
To the euro, yeah, of course.
Compared to the euro. Speaking about this delta, this difference between two types of inflation, and you will see this different inflation impacting on the exchange rate.
Also?
Yeah, because the forint will depreciate against euro because of inflation.
Okay.
So let's say about 4 and 2% against euro. You see that even from the exchange rate point of view, you have a depreciation of the forint against euro that in average is 2% per year in the last 20 years. So this is the gap between the currency, and that's why sometimes it's better even to have some euro in your portfolio.
And also, just to make it clear for everyone, 4% in Hungary, if I don't find any investment which can produce 4%, then I lose buying power every year.
Every year, 4%, right? Of course.
So now if I don't do anything with my money, it's minus 4% per year.
4% per year.
If I find something that can earn like 2%, I can lose only minus 2%.
Yeah.
But if I find something which is like 14%,
then you gain 10%.
I gain 10%, but not 14% because of inflation.
Yeah, when we compare yields, we have always have in mind the inflation, because you can have your bond, you have your net income on the bond, tax net from the taxes. But then if you have minus the inflation, you are losing money and you are not doing a good job with your savings.
Yep.
And beat the inflation is not something easy without risk.
Without risk, yeah, that's what we talk about. Let's go back to the investment vehicles. Can you explain in one, 2 sentences, like what is a stock, what is a bond, and what is an ETF?
Well, let's compare these. When you go to the restaurant, let's say, if you own the stocks of the restaurant, you own part of the restaurant.
Okay.
If you own bond, it means that you lend the money to the restaurant.
So I give a loan.
You give a loan to the restaurant, and he can use as he wants. Then if you have an ETF, you can ETF of stock and of bond. If you have the ETF stock, it means that you own a little part of several restaurants.
Like many restaurants,
many
like
restaurants.
Pizza, pasta, everything.
Everything.
Okay.
Is it good? Of course, because you enter in the topic of diversification. Diversification, it means that if one restaurant goes bad, probably the others goes a little bit better. Hopefully they will go a little bit better. If one go in insolvency because the management is not able to run it, you will lose only a part of your capital. But if you own only one stock of that restaurant, you lose everything. So ETF was introduced around 2004, and it's let's say pretty new instrument, and but it's getting more and more common in the portfolios. Bond is the same. I'm lending money to you, hoping that you will give them back to me one day. But everything can happen to you.
of course.
You can even decide to go to live in Bahamas and forget about me. In that case, what can I do? I have to chase you around the world to get back my money. With an ETF of bonds, I have several.
You lend several bonds. Yeah.
I can buy several bonds, so I lend money to several people. Even in that case, if one of them will go in insolvency, I have all the others that keep my wealth alive.
Okay, so let's do here ETF stock. This is the stock one.
Yeah.
This is the bond one. Can we put like a risk factor to all of these? Which is the less risky? Which is the most risky, on average?
Well, of course, bonds are for safety, as we were discussing about the pillars is for cash flow.
Okay.
So if you place your money in a bond, you have to understand, first of all, the credit risk that of the counterpart, to understand if it's an investment grade or if a junk bond. Everybody has heard these words from the news. Investment grade, it means that they are good company.
They're credible company.
They are credible, and you have really a low percentage. It's under 4%, if I remember well, of risk to get an insolvency. Then there are several classifications even about investment grade. If it's junk bond, then the risk is bigger, and why you usually buy both of them, because of the different yields. More risk, more gain, but it's and that's why we can use different type of bonds for different purpose, and the ETF help you to mitigate the risk.
Yeah. So in my knowledge, ETF bonds are the most safe one.
We can say, but even here, I show you during the course that even with bonds you can lose even 30%.
Of course.
So if you don't know what you are buying,
it's not safe.
It's not safe. And there is these rules that if you cannot understand, you cannot explain what you are buying, it's better that you don't.
You know, it's funny because every time when they ask me on the internet, like, where to invest my money, I always say, like, invest in your knowledge. Because if you don't know where to invest, the first thing you need to do is invest in your knowledge.
We go back to the driving license. You cannot drive a truck if you don't have a driving license. You cannot drive your car without driving license. It's a suicide.
Yeah. So on average, we can say like this is the most safe one and this is the risky one, the stock.
It's risky in terms of volatility.
Volatility, okay. What is volatility?
Volatility, let's say you have the average yield of your stock. The volatility is measured with standard deviation.
Okay.
It's the average of variation that your stock get from.
So it can go up and go down and up and down and down. And this is like not so much. It's like
exactly. And the standard variation is, let's say, the channel. Where this variation in average.
This part.
In average, exactly. So it can be plus and minus. I give you an example. We can buy a stock that has 10% historical yield. Let's say that my expectation will be that in the next 10 years to get almost the same. Nobody can predict this. And if there is a standard variation that is plus minus 10%, it means that there are periods where I can gain 20%, but periods where I can earn zero. But even more, because it's not just this. Standard deviation is an average.
Okay.
So I can even double the standard deviation or triple the standard deviation. Okay. So there is a statistical formula that gives you this percentage. So in 99% of the cases, your bond will stay in 3 times the standard variation. Okay, 99% of the cases, it means that if you have 10%, you can even lose 20%. Okay, but then you can even gain 30%.
Yeah, understand.
And then when you are investing and you see that you are minus 20%, minus 30%, well, It's not that easy.
Yeah, it's like different, like when you invest also, because everyone was talking about S&P 500, which is like the 500 I don't know, biggest in America,
yeah,
or
in America.
And they say that it has like 10 or 11% historical returns.
Yeah.
But I read like a paper, if you invested in 2019 and you took out like 2021 or 22, you were like zero.
Yeah, it's called the lost decades in finance, because you lose 10 years from your income.
Yeah, because it was like doing like this.
Yeah.
If you buy here, you need to wait here just to be at 0%.
Exactly. But what does it mean? That in 10 years you are at zero. But in 10 years we got the inflation.
Yep.
So you should be at least something more than 20%.
Yep.
So you lost, even if you're at zero, you lost 20% in 10 years.
Because of the inflation.
Because of the inflation. So even your stock were equal to the beginning, but your power, purchase power is less.
It's going down. It's going down. Yeah.
So that's why we said when we were speaking about the 4 pillar, 10 years.
10 years.
Because there are studies that said that in 10 years you have huge probability to see back your money.
Okay.
Not to gain, to see back your money.
Okay. Now we have this. Like, how do you recommend someone to take their first step with this one? Like the research stocks, bonds, ETFs.
First of all, go back to the driving license.
Okay.
And you need a driving license.
Yep.
You need to understand what you are doing and how you can avoid the truck on your lane.
Okay.
Before you smash against it. So as you said, training and studying, because this is what I did. Even if I came from economical studies, I have a bachelor degrees in economy, in finance economy. I was working in finance for 20 years. I had to go back to school and learn what does it mean finance, understand the best practice, understand what does it mean risk, and understand how I should structure my portfolio. This is why I started this course here in Hungary. At the beginning it was mainly for foreigners, because when we arrive in Hungary, for us it's a shock.
Of course, yeah.
It's a shock because we are facing a system that maybe I saw at the beginning 25 years ago when I started to invest. It was already much more advanced than what is here. And face the banks here, it's really a nightmare for somebody from outside. Then there are even some upside, for example, the taxation.
Yeah, we will talk about that.
Okay, good. So I will not spoil.
Yeah.
So as foreign, you have to learn. Then, step by step, I understood that there are a lot of cases of Hungarians that need it, because the level of, I understood later that the level of knowledge in these fields in Europe is really low. Yeah. It's not just Hungary, it's not just Italy, it's France, Spain. Basically, all the southern area countries of Europe, they have a huge lack of these things, and you cannot live without this knowledge.
And of course, in this part, there are also free and paid lessons.
Yeah.
For the paid one, we can mention your course. Of course, I can take that because it was really good. So I can recommend it. What if someone has really little money or don't want to invest anything? What is free options can you recommend?
Well, I started to play golf a couple of years ago.
Okay.
And play golf, it means a lot of money for the trainers.
Exactly.
Mainly. And so we were a group of friends, and we started to watch what is the tutorial on YouTube, how to learn. Tutorial. And we tried to save some money from the trainings, from the trainers. We realized that we had a problem, because if you follow those suggestions on YouTube, you fix that particular thing.
Exactly.
But what happened that your swing is getting better for that moment, but then you lost completely the balance on the rest of the movement.
Exactly.
And this is the risk if you follow trainings on the internet. The financial influencer, they call it financial influencers, because what they said is usually correct, but maybe it's not matching what you need at that moment.
And it's not the whole picture.
Is not you don't have the whole picture. So you need, before to follow those financial influencers, you need to understand your financial situation. You need to understand what is achievable for you. You have to understand how much money you can use for crypto and the rest. Because then if you start, and this is what is happening between the youngsters, so the 20 and 30 years old people, the guys that comes to the guys, 30 years old. You are not a guy anymore. They follow this financial influencer. They think to become rich overnight. Crypto can save them from the poverty, and at the end they lose all the money that they have, the money that they inherited from the grandmother that died. They sold the apartment to buy crypto, and this is why I'm concerned about crypto, because now these financial influencers, they are making disaster between the youngsters.
That's true, because of course when I was younger, I also want to like hit a home run, you know, and just put my money where I think is the most profitable, but didn't know anything about risks. So I also lose some money, also gain some money, but it's mainly luck that I gain that much. So also one more question here. Can you recommend any books on investing and finance that you think is good?
There are several. I don't know in Hungarian.
In English it's okay.
In English, there are the 4 pillars, for example. Yeah, the Black Swan.
The Black Swan.
Interesting, from Taleb.
Nassim Taleb, yeah.
Yeah, and everything that he wrote is interesting. And now I have the titles in Italian.
Italian.
Yeah, so I'm not sure to give you the correct, but if Nassim Taleb is a really good one.
Yeah, we also have Nassim Taleb in our application a lot. And also, which one book is really good, The Intelligent Investor.
Yeah, Benjamin
Graham.
Yeah, I would say that even if you read, then you have to understand the company. Okay. He's teaching you how to understand the company. Okay. But to understand the company, it's not enough. Okay. A book. It's not enough. Even for me, it's not enough. Even if I understand everything from a financial statement, it's not enough.
And also, for reverse budgeting, have you read The Psychology of Money? From Morgan Housel.
No.
It's a really, really good book about the psychology of money and why we buy stuff and how to control our emotions in buying stuff. So it's a good one to reduce your costs and outgoings. But of course, I also tell that YouTube and podcasts like this is like really good starting point.
Yeah.
But the problem is that you only get like a pie of the whole cake.
Yes.
If you are more serious, you can go to an in-person training, a conference or something like that.
I'm in support of personal trainings because and especially where there are small groups.
Yep.
Because it should be almost one-to-one. If you want to learn something, it's something that you have to practice.
Yep.
And when you practice, you need somebody that is looking at you from outside and is telling, listen, this is a mistake because of this, or this is a good point because of that. And it's something that you cannot do alone, because you are lost in your thoughts, and you cannot recognize that you are doing a mistake. If you do sports, you know how does it work.
Exactly, same. I know what stock to buy and what bonds I want. Where can I buy them?
The first answer is your bank.
Your bank.
Your bank. But then you will realize that the costs here in Hungary
are really
so high that sometimes doesn't worth it.
Yeah, for me it was the same. I opened a broker account at my bank, but then I realized it's so costly.
That's why.
So I closed it after 1 or 2 months.
That's a problem. That's why I said that we are at the 70s. The banks here, they don't consider the private bank as a real business, and or on the other side, they are working only just for a little part of customer that owns millions. So for some banks, you need something like 100 million forint to start your private bank account.
Cool.
But even in that case, not always you have a serious service from the other side. And as you said, you will find yourself with pre-ready instruments
because
on the shelf.
In the bank, normally, like in Hungary, there are like two parts of this, because I can go to my bank without opening a brokerage account and ask them that I want to invest my money. But they will only say, like, you have like 3 options, like a safe one, a medium, or risk.
Exactly. Then you have to play the risk.
Yeah, because
otherwise you cannot do anything else.
Because otherwise you lose from the inflation.
This is because of MiFID, and it's not their fault in this case. It's the MiFID that I think that is not built properly.
What is MiFID?
MiFID is the European rules that is driving the banks and the financial institution to protect you.
Okay.
To protect the consumers. So MiFID, following MiFID, you have to know your client, you have to be sure that you are selling him instruments that he understands. Okay, but what is happening on the market is that then you write that you understand everything, and in reality, it's not true. And it's a problem because you avoid the MiFID regulation, the protection of the customer, and then you have you have in your portfolio something that you don't want and you are not ready to manage. So MiFID itself is good, but it's the pillars that are more important than the MiFID, because you have to know your personal situation. You don't have to be scared to buy a stock. You have to place the purchase of a stock inside a plan. And if you don't have a plan, you can have all the MiFID that you want. You are not protected. And
the problem is, like, if you want to buy your own stocks that you pick, then you need the brokerage account in the bank.
Yes.
And after that, like, the costs are really high. So I was looking where to invest. And the easiest one was going on Revolut, because on Revolut you can buy it in 1 click. The only problem I realized later that I will pay a lot of taxes if I buy there.
It's not that you will pay a lot of taxes. The real problem is that you are investing in a bank that is not resident in Hungary.
It's in Estonia, I guess.
It's in Estonia, and it's not under the control of the national bank. So if you invest in Hungary, the banks that belongs to and are under the umbrella of the Hungarian National Bank, they have to calculate the tax for you.
Okay.
And it's a real advantage for you, because if you start to trade, then it's a problem. There are a lot of guys that start to use Revolut. They didn't know anything. And this is another problem about the youngsters. So they start to follow the financial influencer, but they don't have a clue what does mean taxation. They start to invest money in it, and then suddenly the NAV catch them, because Revolut, as like every foreign bank, they have to transfer your bank account to the NAV. NAV will discover that you have a bank account in Estonia, and they will ask. What is going on there? It happened even to me with my Italian bank account. NAV came to me and said, "Listen, here you have 10,000 euro. Did you declare this money in Hungary or not?" Luckily, I declared them, but you can be under control
But also, if I want to invest like long term, like I don't want to trade. Don't talk about like trading right now. Just long term investing. There is another one that I learned also before your training, but I learned how to use properly in your training. Is TBS. What is TBS?
TBS is something magic that you have here in Hungary. So it's even other countries, they have TBS. We don't have, unfortunately, in Italy. If you can, do you know what does it mean?
It's like tartós befektetési számla.
Thank you.
Exactly.
So it's for investment long period. The way they were born in 2000. They were established in 2010, if I remember well. Because the government would like to push the people to invest more. Because it's a problem, what you said, that 1% of the population, they have less than 6 months of their... Everything is mapped, so the government knows about it. And it's a problem because one day it's a common problem for the society. So the government decides you can push, you can punish you, or they can give a premium. In this case, they give a premium, and the premium is tax-free. So whatever you gain using a TBS account
So is zero tax.
Is zero tax, and it's a great benefit. Somebody thinks to use the TBS for cryptos. It's good. So if you have great gains, it's really nice to have 0% taxes. But it's even more important for us, people of my age, that we invest in bonds, because with 0%, for example, in euro, what is happening now, the market pays 3.2. Okay. If you get taxed at 28%, it means, let's say 30%, you have to deduct approximately 1 point. So you are a little bit close to the inflation, a little bit under of the inflation.
Exactly.
If I use the TBS, I can gain 1%.
Yeah.
And it's
compounding also.
It's compounding, and this helps me a lot to reduce the risk and to have savings for my life.
But in the TBS, if I know well, you need to invest your money for 5 years.
5 years. It's
so after you...
The aim is to reach 5 years. So if you can reach 5 years, it's zero. It's a super premium. But you can have a little premium even if you ask the money back before the 5 years. So between 3 and 5.
Between 3 and 5.
3 and 5, your taxation will be 10 plus 8.
So
10 is the personal income tax, and the other is the contribution that is so.
Yeah. And what if I don't use TBS? How much is my tax?
It's here in Hungary. It's normally it's 15% plus 13.
15 plus 13%.
Yeah. Then depends on what are the instruments that you are using.
Yeah, sure. Okay, so I can reduce my taxes minus 28% if I use a TBS.
Yes.
Right.
And this is a really, really good option, because even for us foreign, there are a lot of us that keeps their money in Italy.
Yep.
They have to declare in Hungary, and we pay 28% without any reason.
This was one of the best things I learned in the training. Like, so
together with the pillars, give you the path to build your future.
And so, just for everyone to understand, you can have 5 TBS, right? I think you have 5 TBS that is allowed.
No, this was during the course. I said that you have to think to build 5 TBS, because every year, then one is going to expire.
Yep.
So
like this one, I will.
But technically, you cannot have more than one TBS in one
active.
bank.
Yeah. Like you have 5 TBS.
So one can expire in 2030, 2031, 2033, and so on.
Yeah, but this will expire here. So I close this one, get the funds from here, and get a new one.
Exactly. Yes, you can continue.
With 0% tax.
With 0% tax. Because
next year, this will go out. I transfer the funds here with 0% tax.
Perfect.
And go.
Yeah. You can decide if every year you build a TBS. So you need to have a target of yield for every TBS and understand, does it worth to play again, so to invest again, or eventually this 5 years structure is because of even for the retirement.
Yep.
So you know that every year you have a cash flow that you can decide to use or to invest.
Exactly.
And it's something extra about your normal savings.
Exactly. Before we move on, I forgot something to introduce you to our cocktail, because you are Italian, you don't really drink something like this, but I want you to try, Fabio.
What?
This is orange juice.
You know that I don't drink alcohol.
Espresso. It's espresso.
Espresso.
Only. Yeah.
Orange juice and espresso.
Together.
Yeah. No.
Just try it.
Where have you learned this? But it's like pizza with ananas.
No, it's completely not.
Ma no, it's like a carbonara with cream.
Okay, that's true. So cheers, Fabio. Thank you for coming to the podcast.
But this is something that you are offering to everybody.
Yeah. Also ciabatta.
I'm not the first one.
No. How is it?
It's like a pocket coffee inside an orange.
Yeah, you don't need to drink it.
I needed something.
Okay. So.
Thank you, Christoph.
So.
I will not forget this
I'm sure.
This podcast, yes.
I'm sure. Okay, let's talk about risk. first, and then we can introduce Markowitz a bit. Like how we can manage risk in a portfolio.
Risk, you can manage risk with diversification. When we speak about risk, we have and investments, we can start thinking about risk-free.
Risk-free?
What is risk-free? Usually they are government bonds.
Yes, exactly.
Because usually they don't fail. Don't speak with the Greece because they know something. But let's say if you invest in investment grade bonds, they are pretty safe. So they are considered the risk-free parameter. And we said that in euro at the moment is 3%. Then from the risk-free, you have additional risk in your instruments based on the yield that you want to achieve. So this is proof. Much more risk you run, much more gain you can reach. Okay, you can reach. Depend on the condition and a lot of things. I don't want to say that if you go to buy tomorrow the more risky things, you will get the much more income ever.
You know, that's what the financial influencers always say, like no risk, no Ferrari.
Yeah, exactly, yes. No. We have to buy, when we buy an asset, a financial asset, we buy risks.
Okay, that's good.
First of all, so think that you can be stuck in that instrument for years, as you said in the last decades in the Standard & Poor. And then when you build your portfolio, you have to understand your target, as we said with the pillars. Risk-free is for something that you have to, for sure, to see back. Okay, so if I'm planning to have 10,000 euro in 2 years, I need to get 10,000 euro in 2 years, then I play safe and I go with the bonds. But if you want to have a bigger yield, as we said, there is inflation. I want to beat the inflation. It's for long-term investments. It's for my retirement. I will have time to wait. Whatever it happens, can be the Third World War, can be Trump, can be anything, custom duty. You see what is happening now on the market. We have 2 wars, Trump, inflation and everything. Then you have to play with stocks. And when you play with stock, you play with risk. You need to understand what is the risk that you are buying. And first of all, if you are a new investor, don't buy single stock. Don't listen to your cousin, your friend, that they did a lot of money with Apple. That is against the concept of the diversification. Now gold is another asset that is pretty in fashion. Everybody are buying gold, physical gold. You can find even on the shops. Gold, yes, in the last 1 year it was really good. If you check in the last 20 years, it was a decent investment. But for example, Standard & Poor was much better than gold.
Yep.
Okay, so we have to understand what we are buying and to place and to buy the correct instruments, the correct assets, and to place our correct asset in our portfolio is not easy.
Yeah.
That's why you need somebody close to you at the beginning.
So, and diversification means that we buy a lot of things.
Yeah.
And that's why we decrease our risk.
Yes.
So if I buy one stock, it has like this much risk. But if I buy a lot of stocks, one of them like
portfolio,
this. So that's why the overall risk will be like this.
Yeah. Let's say there is a statistical formula that says that over 16 stocks in your portfolio could be enough.
16 stocks.
Yeah.
Okay.
But have you ever had in your portfolio a stock of a company that failed?
Yeah.
Me too. You are stuck there with that stock for the rest of your life. You have to wait the insolvency procedure, the court, and you cannot cancel your portfolio.
All of the stocks that I listened to any of my friends was either failed or minus 70%. so after that, I was pretty famous in my friends group that I always bought at the wrong time, like at the top. I bought one of this investment was NEO, Do you know NIO, the car maker?
The Chinese car maker,
Yeah, I bought in overnight market, and I bought that high that the price haven't
you
even
were able
touched.
to catch the peak.
Yes, haven't even touched that one, and after that it crashed.
But this is the common experience for everybody. That's why, for who has a little bit of literacy that start to have the training, my suggestion is don't start with a single bond. It's too dangerous. You need to get a little bit. It's like to go on the highway with a Ferrari the first day of your driving license.
Okay.
And there was a guy here that you remember that crashed the Ferrari. Yeah, you will finish like that.
And is there anything like over diversification? Like, what if I have 100 stocks in my portfolio?
Well, the problem is that I would never suggest you to buy 16 stocks.
Okay.
Or single stock or 100 stock. I would suggest you to buy an ETF.
Okay, buy an ETF.
Buy an ETF because it's already diversified, and first of all, if you are a fresh investor, go not even for the S&P, but go for a world index.
World index, okay.
And then you can start to build. If you go on my page, Banking Advisory in LinkedIn, there are several articles related to this.
Can you write it here? Or?
You will find several articles about this. One of those is related to the satellite strategy. So if you are a fresh investor, you build your portfolio. First of all, the big pie can be a world index.
Okay.
And then year after year, you can build the satellites that can be, for example, tech. You can have an ETF on the tech market.
Tech market, okay.
Then you can have an ETF on gold, for example.
So as you gain knowledge.
As you gain knowledge, you understand what you are doing, then you build. And this is part of your portfolio, because your portfolio is not something that you build now forever. Every year you have to buy something new.
You rebalance it also.
You rebalance after a while, but this is what it's called strategic allocation. So you design your portfolio. You know that you want in your portfolio world index, tech, gold, Bitcoin in different percentage. So for example, 5%, 5%, then 10%. This is up to the risk of what you want to build. And then you build this satellite even year after year. Or better, with what is called dollar cost average. You have 10,000 euro to invest, and maybe in your your TBS for this year, you can invest 7,000 in world index, and then 1,000 each in the other.
Every year.
Every year. So in this way, you will build, you will spread the risk of what you did to buy at the maximum, and then you have to sell at the minimum.
Okay, so let's talk
there
about
are
this
two strategies.
That's what I wanted to get into, like the dollar cost averaging and lump sum.
We have the lump sum.
Okay.
And DCA, dollar cost averaging.
Okay.
Okay. What is the most used is the cost dollar average, and it works on this idea that market is going up and down, up and down, up and down. If you buy this year at the top, next year you will buy it down, and so it's
average.
Is the average. So you are building. When do we use this? When we don't have the money immediately to invest.
So, for example, if we have like free cash flow every month, we can buy every month.
You can buy every month. You can buy every 3 months. You can buy even every year. So, for example, the TBS, you can build it step by step during the year. The best one would be the lump sum. I can explain with this. So, the market in the long period, it works in this way. Okay. So, you have this, what we saw here. But in the long period, it works like this. Okay. If you have a lump sum, you will buy here, wherever is the year that you are buying, because in the future, the expectation is to be here. Okay. So you got it that if you invest immediately one sum here, it's much better to buy a little bit here, a little bit here, a little bit here.
Understand.
A little bit here.
So if you have your money,
now, let's say you have your house, you are selling your house. It's better to enter into the market now, and if your strategy is long period. So we have to place this inside what is called strategic allocation. Or the other one that you can use is the tactical allocation. So if we are speaking about strategic allocation, we speak about long period. You have your plan done. Okay, so you know that you want to build your satellite with Word or S&P, and then you know what you want to buy here around. You have decided what is the platform, I mean the bank that will support you in this journey, and it should be a bank, in my opinion, that should be an Hungarian bank if you are resident here, that is specific for this kind of investments. There are several institutions here in Hungary that can support you, and they are specific for investors. So you can bring the money out of your bank in a safety way and invest in these institutions. That is not online platform, because online platform, you saw what's happening even with Revolut. It was blocked overnight by the Hungarian law, and who had all my friends that had crypto, they didn't know what to do. And even the big four didn't know what happened. The lawyers didn't know what happened, if it was legal to sell or not. It would be better to have an Hungarian institution under the control of National Bank. Because the National Bank is really checking what is happening inside the banks. So they are protecting you, the activity of the National Bank, other than check the interest rate, is to be sure that your money, they are safe. So in a strategic allocation, lump sum wins over the DCA. Of course, if you cannot, DCA is still a decent option.
Can you recommend any of these Hungarian brokers? And even if someone don't want a Hungarian one, like can you recommend any international ones that you used?
I used to work with the Italian bank here. I don't have experience with the Hungarians. Well, I had experience with OTP. But they, let's say, because of the language barrier and the attitude is not that easy. And then I'm working with another. It's they are not called banks. Where we had the training, for example, SPB. SPB is one of the leader in the market that can support you in this. SPB. It's the bank that I used because of it's really convenient to me. But if you want to go, for example, on the market and go outside Hungary, some of my students, they are using interactive brokers.
It's like eBay. I even use interactive brokers.
Or Trade Republic, for example, that is in Germany. Don't forget that when you are using those, you have to do your tax calculation by yourself.
And also what they don't know about the TBS, because interactive brokers has TBS. But after you open a TBS, it costs you money. One, it's like 2,000 forints per month. It's not a lot, of course, but if you want to invest 10,000 forints, it's like not worth it. But and also
you can open TBS with 25,000 forint, but
and even if you open it, you need 25,000 in it. Like you need to transfer it, and then you need to write to the NAV that you opened this exact TBS. And after the NAV tell you that, I registered it, then you have a live TBS. And most people don't do this. And after 5 years, they realize that, I need to pay taxes on this. So don't forget to register it to the NAV every time you open a TBS.
That's why for an unexperienced investor, use this online platform can be really dangerous. Can be really dangerous. So as a financial advisor, I would suggest to go out of Hungary. If you are not a little bit experienced, if you don't know what you're doing.
So let's go to our last or before last topic, the emotional triggers and how to manage investments emotionally. So
we were speaking about the truck, when you are facing the truck coming to you.
So let's see, I have stock. It goes like this, and I bought here, and now we are here. how to manage this emotionally? Any tips and tricks?
It was funny. I started one of the course exactly the day when Trump started to place the. You remember what happened to the stock exchange in that day? Everybody were asking me, "Sorry, Fabio, but how much are you losing your portfolio?" And I was laughing and say, "Well, 30%." I was not hanging myself out of the windows. So it's when you have your plan, you have your platform, you know the products that you bought. And you have in mind the process about your future, you don't get this emotional roller coaster that you face. Because if you buy a stock, you know that this can happen.
Yep.
And
you should know.
You have to know. If you don't know this, then you are crazy. So you did something that that doesn't fit you. Then there are people that emotionally cannot face, for example, that's I was speaking with some of the students, say, no, Fabio, I don't want to even see a loss, one penny loss in my investment. And in that case, you don't have so many options. You go for bonds, and you tell them, listen, don't think to sell before the expiration, because expiring of the expiring date, because you can lose money even with bonds if you don't respect the timing or the duration of the investment.
For me, this was also a big lesson, because when I bought my first stock, the next day it was going like minus 10%. And I was like, shit, this is my money that I work for.
Exactly.
And it was like devastating for me.
Yes.
And my wiser and older friends told me that, look, this is short term.
Yep.
You need this money now. And I say, no. Okay, so you don't lose 10%, because if you don't take it out, then you didn't lose it. You just need to leave it there because you think it will go up. Otherwise, why would you buy that stock? And when I told it, because one of my friends told me, they said, you're an idiot.
But it happens always even to me. The first time that I buy a stock, the day after go down. Yeah. It goes down. And I say, okay, good. Okay. I never had that pleasure to see. Once I had. Once I woke up a morning and I checked one of the stock that I have in portfolio, it was up to 25% in one day. Fantastic. Okay. A dream.
Yeah, look.
It's like to have a all-in-one in golf.
Yeah. One time I bought it was really in the beginning of my investing journey, and I bought a really small crypto coin. And the platform that I bought it's connected to my portfolio platform. I use Delta. I use Delta, and I take all my portfolio stocks, everything inside there, and it tracks me how many percentage I gain over time. And it didn't match it correctly, and it told me that I gained 30,000% in one day. Wow. I was like, no way.
Let's sell it.
I thought that I'm a millionaire. It was like this, my portfolio. And then I checked it, and it wasn't worse than that. But I was like, no.
No, that's bad.
Yeah. Okay. So,
but about losing money, for example, my personal experience was with Coinbase. I bought Coinbase. Yeah. I went down till minus 70%.
True.
And then at the end I sold them with plus 20. But I had to keep them for 2 years.
Yeah.
For 2 years. And of course, when you do it, you have to place the correct amount. You cannot put all your savings in one stock, hoping that this will be the new Apple for your life. That doesn't happen. It doesn't work like this. If somebody thinks like that, is dead.
Okay. Let's talk about red flags. If you are a beginner investor, what are the red flags for investing? We talked about financial influencers.
Yeah, financial influencer is a big topic, I think, because they start to check even this financial influencer now, because they understood in the market that can create. So, for example, for me to suggest a stock, I have to study 1 year and get this certificate to be able to suggest you to buy it. This financial influencer, they don't have even themselves the knowledge of what they are doing. They're just telling stories, and you buy based on these stories. Well, It's a topic. The second one is the platform, the international platform.
Okay, international platform.
Wait before use them. Wait.
Okay.
And understand what you are doing.
Okay. Third?
Crypto.
Crypto. Okay.
Crypto.
Because of the high risk.
Use them, but in a small percentage, just to feel that and stuck with this percentage. When you see that the crypto goes up, like today Ethereum, I think that it got the maximum in the market since ever. Yeah.
Yep.
Then you, for sure, today a lot of people start to buy Ethereum, even they didn't know what it was before, just because they heard about it.
Yeah, but sometimes when you hear it everywhere, it's not a good time to buy.
Absolutely. When you start, the rule is if everybody are speaking about it, don't do it.
Don't do it. Yeah.
Don't do it.
Actually, there was a famous banker in the 18th century, and he has a quote that I memorized it, which is something like, buy when there is blood on the streets, even when it's your blood.
Exactly. Yeah, it is true. If I had bought Coinbase when it was minus 70, wow.
Yep, exactly.
But I stuck with that percentage because I knew this is the risk that I can run.
Yeah.
And this is the other red flag, to stick to the plan. Because
stick to the plan.
Even for me,
don't stick to the plan. This is the red flag.
No, exactly. Because even for me, sometimes I'm really tempted to move money from bonds to shares. Because when you see that the market is down, you would like to buy. Say this is the moment, the right moment. Then the market goes down again,
Yep.
and then you lost your plan.
Yep.
Tax.
Okay.
Pay attention to tax. Don't pay attention to tax is a red flag. A lot of youngsters, as we said, they don't know what is tax, and they will realize only after. When they gain money, maybe with the crypto, they start to spend all their money, and somebody is knocking at the door and say, where is 30%?
Yes. So the last one, the last big topic for us is like summary or conclusion. Like step by step, maybe we can go through, like from cash flow to everything, like a big roadmap.
So it's basically the index of my course. What we do during
let's do that.
The 3 days of course that we have in banking advisory. The first one is the understand your cash flow.
Cash flow,
and is the reverse budgeting.
This is the first one, the reverse budgeting also?
Yes, absolutely. Okay. The reverse budgeting is the first because you need to understand your cash flow. You need to understand your potential before think what you want to do.
Okay. Next?
Then after the cash flow, we start to build the pillars. So what you want from your life, is your aim in your life. And then you go back again to the reverse budget, and now you start to build the new reverse budget, and you start to work on it, understand what are the next step of your life, get a new job, reduce your cost, and so invest in some school to get promoted. Then you have to build the pillars and be sure that the pillars are fitting your needs. It means to have your cash, your safety fund, your forecast expenses. The forecast expenses is the third pillar, and then you can start to build your portfolio. Okay, so on the second day, we start to build your portfolio from the lower risk first of all, because we need them for the second and third pillar. It's related to the bonds, how to buy bonds. So whatever we said is really nice, but at the end, where can I buy? How can I choose the bond that I need? And you remember that we saw that nice page, internet page, where you can see and you can understand what is the level of the risk and the yield that you can get on the market. After that, we go to see the ETF, how to choose. First of all, you have to build your plan. So choose the ETF that you want to buy. Once you have your plan, then you have to decide what is the platform that you are going to use. So the bank, let's say, which bank or which financial institution, or if you want, internet platform that you like, and this is the you start to execute it, and even to select this. We saw that there are some parameters how to understand the cost that they charge you and what are the target inside your plan, and then monitoring. Monitoring, it means that you don't have to check every day on your phone how is going your portfolio, because don't forget that we built a strategic allocation here. So I would suggest to place a couple of dates in your calendar when you have to check it. And eventually you have to rebalance it. So for example, probably because of the crypto now, you bought cryptos at $30,000. Now they are $100,000. You have 3 times more crypto than you would like to have. Then probably it's better to sell part of it and buy something that is much more safe.
So the ninth one is rebalance.
Rebalance. Monitoring and rebalancing. And then enjoy your retirement. Enjoy a cocktail on the seaside.
Perfect. Yeah, that's really nice actually, because that's what I wanted. So when I invited you, that was in my head. Like, I want the viewer so that we go through this, and he or she understands like every step a bit. Even if he wants like this, he can learn about that online. He can go to your personal course. But now maybe someone can start because he has a plan, or maybe someone can know that, oh, I'm missing information here, so I need to attack this part.
Usually the guys that comes, the girls and the wives that are coming to my courses, after that they start to follow financial influencers, because they can understand what they are saying. And then they can choose the correct financial influencer, because several of them, they just speak and they are not that technical. After this course, then you can start to follow the more technical one.
Any good tips, advice for people who want to start, just to close this epic podcast together?
Come to my training to my course for sure. It will be. I think that it was enjoyable, from not just interesting, but it's. I'm keeping it enjoyable, because finance at the end is not Excel tables. It's how. Even my job, my activity is not make the nice table for the owners, but is to understand what are the risks in every decision that we do, and this part. It's for this reason. You have to understand the risk. As you said, we are buying risks. And if you don't know what you are buying, then it's a problem again. The rest, there are some nice books. Eventually I can give you a list.
We can do that.
That you can share with your followers, and they can start with. That's all I would say.
Perfect. So before you go, I always give like a gift.
Not again the coffee.
I don't know. Maybe it's not for you, but for your children, it would be like epic. This is our book. It's in Hungarian.
My wife.
Maybe for her.
She's a great reader.
And I would like to give it to you. Thank you very much, Fabio, for coming here and also teaching us this.
Thank you, Christoph. It was a pleasure.
It was nice. Thank you very much. And before you go, where they can find more information about you and where they can contact you?
I'm keeping my. It's a blog. It's on LinkedIn. They can search for banking advisory.
Perfect.
It's or I'm building now a page that is called Apple Melinda, because Apple Melinda is one of the characters that we study. On Facebook.
It's on Facebook.
Yeah.
Okay, so we will link it below.
Apple.Melinda.
We will link it below.
Okay.
So thank you very much for everything that tuning in. Thank you, Fabio.
Thank you. Bye-bye. Bye.